Accounting relies on the double-entry system to document transactions, capturing the economic activities of a business. This system ensures that every transaction impacts at least two accounts, maintaining the principle that what happens in one account must correspondingly affect another. These interactions are represented through debits and credits. The origins of debits and credits trace back to the 13th century when debit signified to owe and credit meant to entrust. Over time, their meanings have expanded to reflect the flow of economic activities within a business. A debit represents where economic resources are directed, their destination, while a credit signifies where those resources originate, their source. In simpler terms, a credit is the giver and a debit is the receiver. To better understand how debits and credits function, we can explore their relationship through the lens of the accounting equation. The accounting equation, assets equals liabilities plus equity, is elegantly designed to highlight the interplay and importance of debits and credits. By using this equation as a framework, I will demonstrate how debits and credits play a crucial role in maintaining balance and reflecting a business's financial activities. The first step is to identify what a business owns or controls, known as assets. Assets represent a company's resources and are the initial component of the accounting equation. When a business acquires an asset, it is recorded as a debit to that asset account, which increases its balance. On the other hand, recording a credit to an asset account decreases its balance. Next, we determine the sources of funding for the assets, represented by liabilities and equity. These components are shown on the right side of the accounting equation. To record a liability, you credit the account, which increases its balance. Conversely, debiting a liability reduces its balance. Equity, the third component of the accounting equation, consists of four elements: owner contributions, capital, owner withdrawals, revenues, and expenses. Owner contributions increase with a credit, while owner withdrawals increase with a debit. Similarly, revenues increase with a credit, while expenses increase with a debit. Since owner contributions and revenues typically exceed withdrawals and expenses, equity generally shows a credit balance overall. The representation of debits and credits within the accounting equation reflects their dynamic relationship. Changes on one side, the left or debit side, always correspond to opposite changes on the other side, the right or credit side, maintaining the balance of the equation. In the next video, I will dive deeper into the relationship between debits and credits within the framework of the accounting equation.